This video is for educational purposes only and is not financial advice. Always consult a professional before investing. Alright, listen up. Before we dive in, let's get one thing straight. This is for educational purposes only. I'm here to teach you and show you the signs. But this is not financial advice. The S&P 500 just took a 5% haircut this month. Is this the crash? Historically, October can be spooky for markets. Consider this a wake-up call. Let's get educated on what's happening out there. Meet Sarah. She's a diligent, everyday investor. First thing she checks, the PE ratio. The market is trading at around 28 times earnings versus a long-term average near 15 to 16. For every dollar of profit, investors are paying about $28. That's pricey. Prices may be running ahead of profits. Froth can disappear fast. Next, inflation. The latest read is 3.2%, above the Fed's 2% target. Persistent inflation eats away at returns and profits. It pressures the Fed to keep rates higher for longer, raising borrowing costs. When yields rise, bonds look more attractive versus risky stocks, weighing on momentum. Then she checks the yield curve, and it's inverted. The 2-year yield sits slightly above the 10-year. The spread is about minus 0.15%. Historically, an inverted curve has preceded most recessions. It's a caution flag you shouldn't ignore. Let's rewind to 1987. Markets were surging, valuations stretched. Sound familiar? A sense of invincibility set in, much like today's high multiples. When selling began, automated trades amplified it into a historic collapse. Fast forward to 2008. Different catalyst, similar warnings, housing excess and subprime risk. The curve inverted in 2006. The Fed was hiking to cool inflation. Investors shrugged off signals. Those 4 words became very expensive. What connects 87, 08 and October 2025? It's a cocktail of lofty valuations and monetary policy uncertainty, plus a catalyst that can spook an already nervous market. Today, stubborn inflation, an inverted curve, and geopolitical hotspots. When perception outruns reality, one bad headline can topple a fragile structure. How nervous is the market? Look at the VIX, the fear gauge. Below 15 is complacent, above 30 is panic. Right now, VIX sits around 20, moderate risk. That level suggests investors are starting to buy protection. Take note. Don't sell everything and hide cash under the mattress. Don't be a bear, but don't be a blind bull either. It's time to play defense. First move, diversify. Consider broad market exposure like VTI to own thousands of companies, not just a handful. With today's rates, bonds are back. Long treasuries can hedge equity drawdowns. An ETF like TLT offers exposure to 20-plus-year treasuries. When fear rises, money often flows into treasuries, helping cushion portfolios. Here's your dashboard. S&P 500, PE 28x, high valuation. Inflation, 3.2%, drag and Fed pressure. Yield curve, 10Y, 2Y, 0.15%, recession warning. VX, 20, moderate fear. Action items, review your holdings, trim speculative winners, ensure a healthy asset mix, and keep some cash ready. Build an all-weather plan. It's not about perfect timing, it's about durable preparation. We've seen the signs and the history, and built a plan. Now, is your portfolio ready for this? Have you viewed your holdings through these warning signals? Are you over-concentrated in the riskiest corners, hoping for one more leg up? Or have you built a durable mix that can handle turbulence? Be proactive, not reactive. When did you last rebalance and stress test? Do you have a shopping list ready if markets drop 10% or 20%? Crashes are scary, and they're opportunities for prepared investors with courage and capital. What are you seeing out there? Are you battening down the hatches or getting ready to buy the dip? Share your strategies to protect money and prepare for opportunities. Subscribe for crash-proof tips. Comment your strategy. Now go do your homework. Booyah.